Hi, my name is Adam Bethel, and thanks for joining me today for this webinar on making college funding more manageable for your family. And I want to commend you for joining me. You know, this is a subject that many people would rather avoid than discuss. It's so complicated and confusing, and we know that college costs are on the rise at a time when college is arguably more important than ever. I want to start by telling you a little bit about myself. When I was 25 years old and freshly out of college, I came to the realization that I had a tough time paying some of the bills, so I had some credit card debt that I had accrued. My wife and I had student loan bills that were coming due, and we owed about $50,000 on the student loans. We bought our first house that we were very proud of, but at the same time that house lost value, and we owed more than it was worth on the house at that time. And so that was a difficult time for me, and I had to figure out how to dig myself out of that spot. And the way I chose to do that was by reading a lot of books. I wanted to read anything I could get my hands on that I thought would help me. And so I also attended some seminars and programs. One of the ones I went to was called Personal Mastery by a group called Clemmer and Associates. There I learned that I wasn't actively choosing my own path. I was just responding to everything that came up with pre-programming that was probably instilled upon me throughout my childhood. But I chose at that time to take control. I chose responsibility, and I chose that I never wanted to feel out of control financially again. And so what I've learned in this process are some things that I think can shorten your learning curve, and I think we can help get you where you want to be, which is getting your kids into college and making the process of paying for it more manageable. So I think we have some specific action steps that we're going to talk about today that you can implement so that this process won't be as painful as it has been for me. The first concept I want to hit is the cost of attendance and understanding all of the things that are included in the cost of attendance. The best way to do that is to give you a specific example. And the first example I used was real numbers from a public university and its in-state tuition rates. The tuition and fees were $6,900. The room and board was $8,500. Their estimate for books and supplies for the year was $494. Personal expenses were over $2,500. And personal expenses include things like cell phone bills, car insurance, entertainment expenses, laundry, and of course extra pizza money. Transportation expenses include costs of getting back and forth from home to school and getting around campus, and it was $1,300 in this case. That brings the total to $19,855. It's important to understand that these estimates are based on the average experience for all students and will not be your exact expenses. But these are the numbers that are used in the formula that we'll get into in a little bit. To contrast the state university, we also looked at the big private school. An example of a specific school on this end of the spectrum was tuition of $47,000 a year, room and board of $14,000 a year, books and supplies over $1,800, personal expenses of just under $2,000, and transportation of only $400. However, the total at this school each year is $65,844 for the total cost of attendance. So now that we know how much college will cost and how to find out how they price schools at different schools across the country, let's figure out what are the options of how to pay for school. The first one is by saving the money up. And some of you probably have money saved up, and others of you may not have started that process yet. I like to point out that it's never too early to begin this process. But I also like to point out that I think a lot of people have a fear of saving too much money for college because they're afraid that it's going to hurt their eligibility to get financial aid. And the answer is that it can. It really can affect your eligibility for financial aid. But we're going to try to point out some ways that you can do this that aren't going to negatively impact your eligibility for need-based aid. Second option is borrowing. Taking out that debt. So there's student loans, there's parent loans. I think everyone has a level of familiarity and comfort with the fact that you can borrow money to get your kids through college. There's a common saying that is, you can borrow money to send your kids to college, but you can't borrow money to retire, which is very true. It's also true that I've seen families get in trouble over borrowing for college. And so we don't want you to be in that spot, which is why we're taking the time to go through this today. Number 3, scholarships and grants. Hey, this is the one that everybody's hoping for, right? This is the least painful thing of all of the options on this board to pay for college, except for, I like to point out that this is the one of these 4 that is not in your control. And in fact, the percentage of the total cost of higher education that comes in the form of private scholarships and grants is less than 3%. It's an exceptionally low number. And the people who determine these scholarships, which aren't you, get to decide who they give them to. They're highly competitive, so they're very, very tough. So you got to temper your expectations. It doesn't mean don't try for them, but go into it understanding that this is not going to pay for college. Number 4, choose a less expensive school. There's a vast difference in the price of college between the high-priced private school and the low-price in-state school. What I like to point out is that does not always equate less dollars out of pocket to the family to go to the less expensive school. In fact, I'm going to show an example later that flips that logic upside down. So if you stick around for that, we'll definitely talk about that, but right now these are the ways to pay for college. This is a good time to start learning about the financial aid process. You may have heard of the FAFSA. It stands for Free Application for Federal Student Aid, and here's how you do it. You can see the website I'm on, fafsa.ed.gov. To get started, simply click here and start entering your student's name, social security number, and birthday. The rest of the information that's required after this is largely about the income and assets of the parents and the students. So if you have your tax return and asset information together before you start this process, it is much less painful. You are also asked to create a password so your work will be saved if you can't do it all at once. But before you finalize your FAFSA, you must electronically sign. Here's what that page looks like. Both the student and the parent need to enter a PIN number to electronically sign the document and agree to the terms of service before clicking Submit My FAFSA Now. Before you can enter that PIN number, you must apply for a PIN number, both the parent and the student. Applying for a PIN number is very simple and takes only a couple of minutes. You simply go to pin.ed.gov and you'll come to this website. Click Apply Now and Next, and you'll begin entering your personal information such as social security number, your name, your birthday, your address, your email address. You have a challenge question, and then you create your own 4-digit PIN number. That's all it takes to create a PIN number. This process takes only a couple of minutes. All right, now that we've completed the FAFSA and you've seen where to go to fill it out, we're going to skip through the filling it out and we're going to cover the highlights to show you what comes next. The next thing that comes after you fill your FAFSA are these 3 letters, which I think is the most critical piece of information to understand when going into the college funding planning process. And they are EFC, which stands for Expected Family Contribution. After you complete your FAFSA and you hit submit for the final time, you e-sign it with your PIN numbers, you'll be sent to a congratulations page and it will show you what your expected family contribution is and any federal aid you're eligible for. The expected family contribution is comprised of a lot of information, but I'm going to hit the highlights with the SMART family that I'll introduce now. They're a family of 4. Parents are 46 and 45. They have 2 children, a senior that's 18 and a freshman in high school that's 15. The income of mom and dad is $100,000, and their liquid assets are $60,000. Now, in this example, liquid assets include bank accounts, checking, savings, money markets, CDs. That includes stocks, mutual funds that are not inside retirement accounts. It includes 529s. It does not include qualified retirement accounts, so it doesn't include the money that they're putting in their 401k at work. And it doesn't include equity in their home. that they have. Those things do not have to be reported in the FAFSA. Next is the student income. Student made $3,000 in a summer job. And between what she has earned and saved and what her parents maybe put in a custodial account for her when she was young, she has $10,000 of investments in her name. Now again, there could be family with a lot of these same dynamics that have different expected family contributions, but for this family, their expected family contribution is $22,400. So here's the formula for how financial need is determined. COA, which we know to be cost of attendance and includes the entire cost of attendance, minus expected family contribution equals your eligibility for need-based aid. So now that we understand how schools determine your eligibility for need-based aid, we need to talk about how they meet that need. And the answer is they don't all do it the same way. Some schools, a rare few, do meet 100% of need for all students that are admitted. That is very rare. Many schools meet less than that, some substantially less than that. But I find the typical range is, on average, maybe in the 70 to 80% range. Let's take a look at the computer to see what that really looks like. So remember, some schools do meet 100% of need while others meet less than 50%. The best way to understand this concept is to look at an example. For example, School A, which costs $20,000, meets 100% of need, and the family's expected family contribution is $10,000. So the $20,000 cost of attendance minus the $10,000 expected family contribution equals an eligibility for $10,000 of need-based aid. If the school meets 100% of that need, this family should expect a $10,000 award letter and should expect to owe $10,000 to send their kid to school there. If another school that's also $20,000 only meets 50% of need, the same family would have the same $10,000 need, but that need would only be met halfway, or $5,000, which means that the other $5,000 would be added on to the $10,000 that they were paying, and they would now be expected to come up with $15,000 a year to send their child to that school. This is a very important concept to understand because schools do not meet need equally. And this information really needs to be known before you start the process of applying. Okay, so now that you understand how schools meet need, it's important to understand there are two primary ways for them to meet that need. The first is gift aid. This is scholarships, grants, or aid that does not have to be worked off or paid back. And the second one is self-help. This is loans. This is work study, which means that the parents or the student are either going to have to work it off or pay it back. The best way to illustrate how all this comes together is with a case study. For my case study, I've used the big private U and the state U from previous examples, and the most recent family with a $10,000 EFC for simple math. You can see that this family is eligible for need-based aid at both schools. But how do schools meet the need? Here's the answer. Big Private U meets 100% of need and 84% of it with gift aid. This is phenomenal. How about the State U? They meet only 57% of need, and the majority of that comes in the form of self-help. So what would a family with a $10,000 EFC, considering these two schools, actually pay? At the Big Private U, they would pay $10,000 because all of their need is met. Again, that is what makes this concept so important to understand. At the State U, they would pay the $10,000 EFC plus the $4,200 of unmet need for a total cost of $14,238. So which school costs mom and dad more? The State U. Now, this is just one example, so this won't work for every family in every situation, but I see it often enough that I feel that it's important to point out in this way. But what if we change this family to the Smart Family example that we also talked about earlier? If you remember, their expected family contribution was $22,400. So keeping everything else the same, now which school costs the family more? It swings back over to the private U. So again, this is not a universal truth that every family can send their child to big private U for less money than the state U, but this is an example of how sometimes it does work that way. We've covered a lot of information so far in today's webinars, but there's two more concepts that I want to cover before we wrap this up. Concept number one is negotiating award letters. We want you to understand in this process that in many cases it is possible to request and receive additional financial aid after that initial award letter comes in. However, there are a lot of factors involved, and we will cover this whole process in depth in webinar number 2. Okay? Concept number 2 is the ability for a family to increase their eligibility for financial aid. In many cases, a family that has not yet filed their FAFSA has the ability to make changes to their financial situation that increases their eligibility for financial aid by decreasing their expected family contribution. And I want to share with you a case study that illustrates exactly what I mean about that. The case study I'm going to use today is the Smart family from earlier. The parent's income was $100,000 and the child's was $3,000. The parent's assets, excluding home equity and retirement accounts, was $60,000 and the child had $10,000. If you remember, their expected family contribution was $22,400. Now, what's the first thing you notice about that EFC? To me, it seems high. Approximately 20% of their gross income seems like a stretch. It's important to understand this because this formula is not in your favor. So it makes it even more important to understand the possibility of the next concept. The next family could also be the Smart family. All the numbers are the same. The only difference is they understood how to position everything properly to maximize their eligibility for need-based aid. So what do you notice about that family's EFC? Well, the first thing I notice is that it's still high, but it's not as high as it used to be. In fact, that difference could be worth $16,800 over 4 years, or $33,000 plus for their 2 kids' 4 years of college. I don't know about you, but to me that is a big deal. It's very much worth paying attention to, and it's why we're going to go in depth into this process and understanding this in webinar number 2. So let's recap everything we've covered today. The purpose was to give you an overview of the college funding process and give you insights that will give you an advantage when you go into the process of paying for college for your children. You should now understand the concepts of cost of attendance, what the FAFSA is, where to go to fill it out, and what expected family contribution is and why it's so important. You should also understand now that not all schools meet financial need the same, and we're going to talk about in the future how to research and find out how they do meet that need. With all this information that you have today, you've got the bases covered. The next step you need to be able to do is to apply all of this to your situation. I've given some generic examples, but you really need to know what all of these numbers mean for you. Once you know that, you can figure out how much it's actually going to cost you to send your kids to college and be able to make a plan for how to pay for it. Thanks again for joining me on today's webinar, and congratulations on taking this step to begin your educational journey. You've certainly learned some key concepts and some vocabulary in how the college funding process works that will serve you well. But there's one big takeaway that I want you to get from all of this, and that is that everything we've talked about so far is great and it will help you. But you need to understand what all those concepts mean for your family. You need to understand what the costs are of the schools that your children are considering attending. You need to understand, if you filed a FAFSA today, what would your expected family contribution be? These are the things that are going to put you in the driver's seat to having a successful college funding experience and make this process much more manageable than what you've heard horror stories from other people. And one last plug for our next webinar, that's exactly what we're going to cover. I'm going to teach you exactly how to determine what your cost of attendance would be at any college. I'm going to teach you how to determine exactly what your expected family contribution would be if you were to file a FAFSA today, and whether or not you have an eligibility to decrease that expected family contribution. We're going to go through all of those steps and in a process understand what are things to look for to know whether or not you have an ability to negotiate an award letter once it comes in. So again, those are things that we're going to keep teaching, and hopefully we'll be able to serve you again in the future. For today, I hope this was great for you. Thanks a lot.